me? Please confirm if you can hear me clearly.
Yes, ma'am, we can hear you.
All right.
Yeah, I can hear you.
Great. Thank you so much, everyone, for joining. Thank you for your coffee so much. Yeah, welcome once again to day 2. If you were here yesterday, we started day 1 of the Cyber Securities Competition Trading Training Session. We went through the topic, the overview of Nigerian equities markets, and today is day 2. So I believe you all received the recordings and documents to study subsequently. Okay, great. Thank you so much for your reaction. All right, so today we'll be having day 2. The topic for today is fundamentals of stock analysis and trading strategies. This session will be led by Olayemi Ogunbade. Before we go into the training proper for today, yesterday some universities were unable to introduce themselves, so I'll call on the outstanding universities. Please just introduce yourself, your team, and your position on the team. I'll start with Nnamdi Azikiwe University. If you are on this call today, please introduce yourself. You can signify by raising your hand. Okay, great. Thank you so much, Fedrak. Kindly unmute your mic, introduce yourself, your team, and your position on the team.
Okay, good afternoon, everyone. My name is Chidike Shedrak from Nnamdi Azikiwe University. I'm currently the team lead, and we are happy to be part of this edition of the trading competition. We are also the returning winners of the 3rd edition. Thank you.
Awesome. Thank you so much. Congratulations on your winnings. You're welcome. Okay, so the next university is Federal University of Technology, Akure. You were not on the call yesterday. If you are here today, please signify by raising your hand. Okay, Boluwatife, please introduce yourself, your team, and your position on the team.
All right, good afternoon. My name is Akimba Buluwatife. We are Team Maverick, and we are from the Federal University of Technology, Akure.
All right, thank you so much, Boluwatife.
Thank you very much, ma'am.
All right, enjoy. Okay, the next university is Ajayi Crowther University. You were not on the call yesterday. If any participants from Ajayi Crowther University is on the call, kindly signify by raising your hand. Okay, Oluwatosin. Please introduce yourself, your team, and the position of your team.
Hi everyone, good evening. My name is Olalekan, and I'm the team lead for Ajayi Crowther University. So I didn't get the last thing you said. Can anybody hear?
All right, thank you so Thank you, Oluwatosin. The next university is Joseph Ayo Babalola University. If any participant is on the call today, please signify by raising your hand. Okay, David, please go ahead. Introduce yourself, your team, and your position on the team.
Good afternoon, everyone. My name is Chizi David. I'm from Team Vanguard, and I am the team leader for Team Vanguard. We represent Joseph Ayo Babalola University.
Thank you so much, David. Okay, the next school is University of Ibadan. Any participants from University of Ibadan, please raise your hand and introduce yourself and your team. Anybody from University of Ibadan? Of Ibadan. The next university is University of Ilorin. Any participants from University of Ilorin? Okay, so in the absence of these universities in today's session, I would like to proceed. Thank you all so much for the introductions and introducing yourself and your needs. I have on the call with me the MD Ava Securities Limited. Her name is Adejoke. She's on the call. So please give her a virtual round of applause. Thank you so much, everyone. Okay,
Thank you.
so
Thank you, everyone.
like I mentioned earlier, the facilitator for the next session for day 2 is, thank you so much for your reactions. Thank you. The facilitator is Olayemi Ogungbade. He is investment analyst. So I would read his profile shortly. Olayemi is a budding finance professional with up to 3 years experience in macroeconomic analysis, financial modeling, and multi-asset trading, that is FX, equities, and commodities. He is currently working as an investment banking analyst at Ava Capital Group. He is also pursuing his CFA charter and ACCA certification. Olayemi is passionate about investments, emerging markets, and intra-African trade finance. Please give a virtual round of applause for our next speaker, Olayemi Ogungbade. He'll come up shortly, and the topic he'll be taking is fundamentals of stock analysis and trading strategies. Thank you so much. Thank you so much. So if in a comfortable position, I'd like you to please turn on your video, but if it's not comfortable where you are, it's fine that your video is turned off. It just helps with engagement with the speaker. Okay, thank you so much, Olayemi. I see you are up and ready to go. During this session, you can please put down your questions or clarifications if need be. You can also drop them in the chat box so you don't forget, or just write them down. At the end of his presentation, we'll take questions and answers. Thank you so much, everyone. I hope you have a great session. Over to you, Olayemi.
Thank you very much, Adenike. Good afternoon, everyone. Please confirm that you can hear me loud and clear. Can everybody hear me, please?
Yeah, I can hear you.
All right, thank you very much. So as Adenike has already introduced, I'm going to be facilitating today's session, and the topic for today is going to elaborate on the fundamentals of stock analysis and trading strategies. So what we are basically looking at today is how you actually perform, or how you actually analyze a stock, and how to put a trading strategy together that helps you win in the market. So I will try as much as possible to make sure that the session is as relatable as possible and also interactive, because I expect that majority of attendees on this call are likely new to trading or has quite an encounter with trading. So I'm going to try to, balance the experience across board so that everybody catches up with what it is that we are talking about. So let's begin proper, and let's have the first slide, please. So this is a glance at what we're going to be covering today. First, we'll be looking at what a stock actually is, because I expect that in this competition, every single team or every single university on the competition is basically going to be trading a stock. So we're going to be dissecting and looking into what a stock actually is, And then we'll also be looking at fundamental analysis. We'll also be taking a look at technical analysis, how you do that, how you put together a trading strategy, and also risk management, which is most likely going to be the most important thing that you would want to take away from this session. So please stick around up until the point where we get to risk management so you can actually understand what it is and how to properly manage your risk in the markets. Now, finally, I'll be giving you some tips towards the end of the session to help you, win your competition. So next slide, please. So like I earlier said, we're starting off with what a stock actually is. So if we were to look at a stock is basically a slice of a company. So it is more like you virtually break down a complete company into several pieces, and then you hold some of these several pieces that have been broken down. So three components that we'll be looking at, to fully understand what a stock is the shareholders one. And as you can see on the slide, the shareholder is basically someone who has a holding in a particular company. So the moment you buy a company stock, you are automatically a shareholder of that company. So what you benefit for holding that company stock is usually what they call dividends. So dividends are usually paid periodically. They're just periodical fraction of the company's earnings that you get as a shareholder of that company stock. So a good instance would be where you buy a stock of or you buy a share of maybe MTN. So share and stock can be used interchangeably, just that one is used for quantity and the other is used to calculate a particular amount. So you could buy shares of MTN at a particular point in time, and you could probably buy, let's say, 1,000 or 2,000 units, depending on how much you have. The moment you purchase that stock and you get a purchase contract note, you're automatically a shareholder of MTN. So that's basically who a shareholder is. The fact that you own a piece of a company means that you are a shareholder of that company. Now we'll be looking at the stock exchange itself. The stock exchange is, previous slide, please. So the stock exchange basically is, I have not seen the slide. Okay, let me just go on. So the stock exchange basically is okay, it's up now. Thank you. So the stock exchange basically is more like a marketplace where these stocks that you have bought, or let me say the shares that you have bought from specific companies, are traded. So you can see it as a market or a place where buyers and sellers interact. So people throw in their bids and sellers also throw in their asking price. So usually sellers asking price will always be called the offer. So the interaction between bid and offer is what happens on the stock exchange. And similar stock exchange, or let me say popular stock exchanges around the world, are exchanges like the New York Stock Exchange and the NASDAQ. So markets like that are where buyers and sellers basically meet. Is a meeting point between buyers and sellers where they exchange these shares of companies for cash or whatever contracts, depending on what they need the shares for. As for market capitalization is more of valuing, or let me say, sizing the company. Can you hear me? Can you hear me clearly, please? Yes. Okay.
Yes.
Thank you. All right, thank you very much. So as for market capitalization, as I was saying, I said market cap is basically sizing the amount of shares that a company has and comparing it to that company's share price. So it's more like looking at or estimating the market value of that particular company. So how you calculate the market cap for a company is usually going to be the share price multiplied by the total number of outstanding shares, basically total number of shares that that company has listed on the market. So the moment you multiply both values, it gives you the results, basically is what translates to the market value. And you can see this market capitalization as, like I said, the size of a particular company or the risk profile. So it's usually broken down into various sections. So we have the large cap stock, which is large capitalized stocks. We also have the mid cap stocks, and we also have the low cap stocks. So for large cap stocks on the Nigerian Stock Exchange, you usually see stocks or companies like Dangote Cement. You usually see companies like Boa Cement. You usually see companies like MTN, Zenith Bank, and the likes. They are large cap stock basically because their market cap is usually their market cap is in the region of the top 10, 20, or 30% of the market. So if you compare their market cap to some other companies, they're usually not going to match up to those large caps. So an estimate will be around, say, give or take 51 to 100 billion in market capitalization, and maybe even more. Those are the kind of companies that you usually categorize as large cap companies or large capitalized stocks. So for mid cap stocks, these are just companies that are growing and have a kind of moderate risk profile and can also become future large cap stock if they scale well enough. As for small cap stocks, they're usually at the bottom of the pyramid, and they are usually those companies that are in their early stage or underdeveloped companies, basically. So they usually have very high uncertainty and they have less analyst coverage in their prices and their earnings reports. So usually when you see small capitalized stocks or small capitalized companies, you are not going to hear so much about them. You hardly see reports about those companies. Analysts will hardly analyze such companies because they believe that the growth potential for that company is still, or let me just say that they believe that that company is still underdeveloped and it's not worth investing in at that point in time. So talking of growth potential, it is very easy for a small cap company to double in its stock price or do some kind of massive numbers in growth. So you would want to invest in a small cap company if you really see potential in that small cap company. As for large cap companies, they are more often than not always usually going to be those growth steady stocks whereby you invest in them and you just expect capital appreciation over time. So they are not going to do something very explosive. They are just going to give you that steady returns and perhaps some sort of dividend. So if you invest in a stock like MTN, you'll be expecting capital appreciation over time because you're not expecting MTN to jump from 700 and something naira to about 1,800 or 2,000 plus. It's not going to happen in a short period of time, but over maybe 2-3 years, then you can reasonably see that gradual growth potential in a stock like MTN, because it's a large cap stock. For MTN to do something outrageous, then they are going to need something to move the needle in their revenue. So they will need massive new revenue. And if you look at the fundamentals around that company may not be planning to do something extensive in the short term. So for small cap companies, they can grow very quickly because a small cap company could decide to maybe set up a new manufacturing plant. That's maybe a company. Let's assume a company like Prestona is a small cap company and the stock is trading at around, let's say, 20 or 30 naira per share. A company like that could do 200 or even 300% in the next 6 months or a year because they have a lot more in market share to grab, and there's a lot more earnings for them to make. So if they set up maybe a new manufacturing plant, then you can expect those revenue to move the needle in their annual returns, and then they're just going to have that very massive growth potential that you would expect a small cap company to have. So most of the time you will not, it doesn't mean that small cap companies are always good to invest in. And it doesn't also mean that large cap companies are not always good to invest in. It just depends on how you want to balance your portfolio and how much money you want to allocate to each of these specific companies or specific large or small cap stocks, like you would mostly understand. So a portfolio structure that I would likely recommend would be, say, 50 to 60% of your portfolio goes to large cap stock. This is a balanced portfolio now. 50 to 60% of your portfolio goes to large cap stocks, then about 20 to 30% then go to mid cap for growth, and then 10 to 20% goes to those small cap stocks. So you can take advantage of all three forms of capitalization on the stock market. Next slide, please. So looking at the fundamentals of stock analysis, like I said prior to starting, I said we're going to look at two aspects. One aspect is fundamental analysis and the other is the technical analysis. So I want you to see this fundamental analysis as That's part of analysis where you have to check the news often. You have to check this company's earnings reports. You have to analyze their revenue growth. You have to look at their debt to equity, look at their corporate governance. What are they doing in that company? How are the directors of that companies directing the companies? What are analysts saying about the company? What's the news saying about the company? What reports are we getting about this company? So all of those are fundamental analysis. As for the technicals, we'll speak about that shortly, but let's dissect the fundamental aspect of things first. So first thing first, you want to know the value of that company. And how you know the value of a company is, I would expect that I don't expect any of the attendees here to exactly know how to do a proper, would I say, an extensive form of company valuation yet, but a very simple metric that you can use to value a company is the price to earnings ratio. There are other way advanced forms of valuing a company, but that's a story for a later date. A more direct and, very useful metric to determine the value of a company at this stage for the essence of this competition would be price to earnings ratio. And how do you get the price to earnings ratio? The price to earnings ratio is basically the price of that stock divided by the earnings per share for that stock. So once you divide both, you arrive at a value, and that value that you arrive at gives you, or let me say, results in a ratio. Now, or let me say, what information do you get from this ratio? So I'll give you an example. Like I said, I want to try and make this session as relatable as possible so you understand what I'm actually trying to say. So when you look at price to earnings ratio, let's say, for instance, you have a burger stand. You have a burger stand, you sell burger, and let's say every day, or let me say in a whole day, if you sell all your burgers in a whole day, you make 100 naira. This is just for example now. Let's say you make 100 naira profits every day, and then someone comes one day and says they want to buy your burger business. So they'll do one of two things. They're going to give you a price, and you may have a price in mind as well. So let's say this person wants to buy your burger stand for 1,000 naira. I'm using this small naira amounts for better understanding. So remember that you only make 100 naira in a day, and somebody comes and say they want to pay you 1,000 naira to buy out your burger stand. So if you divide the 1,000 naira, which is the price that they are offering, by the amount of money that you made in a day, which is your earnings, price to earnings, remember. So if you divide the price that they are offering by the earnings that you made, then you arrive at a ratio of 10. So that ratio of 10 means that or let me give two scenarios now. Remember that we have a ratio of 10, then another buyer comes and says they'll pay 5,000 naira for the same company that somebody wanted to pay 1,000 naira for. So if you divide the 5,000 by 100, you're getting the ratio of 50. Now comparing this ratio of 10 and ratio of 50 basically means that for the ratio of 10, it means that the business might not grow as much in the near future. And as for the ratio of 50, the person offering 5,000 naira for your business is basically telling you that they are willing to pay more at this point in time to get, or let me just say they are willing to pay more for your business. So that fact just speaks to the essence that the fact that they are willing to pay more for your business just tells you that your business has a higher value compared to somebody who is planning to pay 1,000 naira to buy out your burger stand. So if you compare both of them now, you would most likely want to sell to the person who will pay you 5,000 naira for your burger stand because the person is valuing it at a much higher ratio. So that's how you get price to earnings ratio for particular companies. So you want to replicate this for companies on the NGX by looking at their annual earnings. That's their earnings for a full year or their earnings for a quarter, depending on when the competition starts or depending on what period exactly you are, looking to analyze that company for. And then you could also compare that to, the price to earnings ratio for another company. Let's say, for instance, Dangote Cement and Boa Cement. You may decide to compare both of them for which one has a higher price to earnings ratio. So you know which one to actually do your money in. So that's basically a metric that you could easily use to get the value of a company, depending on how much you want to invest in that company. Now, another part of fundamental analysis will be revenue growth. And revenue growth is basically looking at how fast the company's top line is going to grow going into the next future. So if a company has a very healthy revenue growth, you would likely want to compare its last maybe 2 or 3 years revenue annually and then see what it numbers. Let's say in 2023 now, a company does 100 million revenue. In 2024, they do 150 million. 2025, they do another 200 million. That's an average of 30 to 50% revenue growth in, year on year. And if you compare that and just estimate going into the future, you would expect that the company would, continue in that trajectory based on maybe the current status of their business, depending on the kind of business that you're looking at, kind of company, or let me say what sector they operate in. So that's the fact that they have positive revenue growth in the last maybe few years gives a high chance that in subsequent years they are going to also get the same, or let me say they are going to get a similarly consistent revenue growth. So the business is basically healthy and you likely want to bet on such kind of business. And now as for return on equity is basically telling you how efficiently the management of a company uses investors' funds to generate profit, just like the name implies, return on equity. So basically, it's return on the equity that is invested in that company. As for EPS or earnings per share, as you might call it, for earnings per share, this is basically looking at how much earnings, or let me say, the net income divided by the share outstanding of that company. So you are looking at how much investors earn for holding a single share of that particular company. So if an investor is holding, let's say 1,000 units of MTN and is earning maybe 1 naira per share, if you compare it to, let's say, Airtel, for example, and is holding the same 1,000 units and is earning 2 naira per share on Airtel. Comparing both of them is Airtel is going to have a higher earnings per share compared to MTN. So in that regard, you may want to invest in Airtel because you expect that going into the future, Airtel is going to pay you perhaps higher dividend compared to MTN. So that's how you use earnings per share to take decisions around fundamental analysis when you want to take a decision as to investing in the stock or not. As for debt to equity ratio. So debt to equity ratio is a metric that measures risk basically. And in measuring risk, you are looking at the total liability of that company or business and comparing it with the shareholders' equity. So if you divide the total liabilities by the amount that shareholders invested in that company, you could compare it for two companies, just like we did for EPS and PE ratio as well. So if you are getting a higher debt to equity ratio, it means that more debt has been invested in that company than equity has been invested. So it's showing that's a signal for very high financial risk, and that may not be a company that you want to invest money in. So you likely want to go for a company that has a low debt to equity ratio, which means that the shareholders actually care about the company. They invest more of their money in that company, and they are not just borrowing money around and hoping one day that the company might collapse and then they leave the company for whatever it is that they want to leave it for. As for free cash flow is basically a metric for measuring the cash strength of a company. So free cash flow is that money that is left after a company has, paid off its loans, spent on capital expenditure, sorted out all of its expenses, paid all its investors dividends. Basically, when it has met all its obligations, and then it just has that idle cash sitting around, maybe wanting to invest it in one thing or another. So that's basically what a free cash flow is. A company that has a high free cash flow would most likely pay you a higher dividend. So if you compare companies across a particular industry, you would most likely want to invest in a company that has a high free cash flow. So this is another tip for your fundamental analysis. And you could combine all of this. Okay, let me just say you could pick all of these 6 metrics and then use them as rationale when deciding which stock you want to invest in when the competition starts. So it is something that you can do, but I would advise that you also look at the news, check what analysts are saying about each of the company stocks that you are recommending to include in your portfolio. Before taking any decision, you want to know what the market is saying about that company's stock or what analysts are saying about it, adding up all of these other metrics. So if you put everything together, I can assure you that you arrive at a very good trading decision. Next slide, please. Please put your questions down. You could maybe write them somewhere so that we attend to them towards the end of the session. Next slide, please. All right, thank you. So the second part of analyzing would be the technical analysis aspect. And under technical analysis, like I said, you're not going to be dealing with news and all of those valuation metrics, cash metrics, and debt to equity ratios. What you would likely be dealing with is the chart itself. So you would want to learn how to read price action to predict future movements. So basically in trading, what you want to look at is what's happened in the past, and then use that to predict what you expect to happen in the future. So you use past data to predict the future in trading, and there are some key indicators that you use to, do these predictions. So basically, one of those key indicators is moving averages. So a moving average is an indicator on your chart. I don't know what platform you'll be using for your analysis, but the industry standard most recommended platform will be TradingView, and I expect that that's what you should be using if you really want to win this EVA securities trading competition. So for moving averages, although I left some keynotes here, but unfortunately, we may not be able to exactly put to test how these moving averages work. Like I said before starting off the session, I said some of us here may have trading experience and some of us may not. But for those of us who do not have trading experiences, I would just advise that you visit online sources, perhaps YouTube or any other source that you may know, to learn how to at least use these key indicators. They are very basic and very simple to use, but unfortunately, if we begin to pick each and every one of them one after the other, we will not leave here today because there's a lot of explanation and settings that go around them, but you could definitely find online resource materials that you could use to learn them. Within a day or two, you would understand them. They are very easy to use. And another indicator would be the RSI. The RSI stands for Relative Strength Index. So what you use that to do is what you use the RSI to do is to measure the strength of a particular stock, a particular instrument. So what you're trying to get with the RSI is you're trying to observe if that instrument has been overbought or it has been oversold. So there are two major levels on the RSI, depending on how you want to set it. But the industry standard level is the 70 level and the 30 level. For the 70 level, once the RSI is hitting the 70 level, it's showing you signs that that particular instrument has been overbought and the price might drop sometime soon. As for the 30 level, it's telling you that it's been oversold and the price might, do some upticks sometime soon. So that's how you use the RSI. This is just, basically a theoretical example, a theoretical explanation. But like I said, please use resources online to learn how to use this. Some traders also adjust their relative strength index to the 80 and 20 level. They believe that gives them a better chance at arriving at a more informed trading decision, but it just depends on however you want to use it. The industry standard is 70 and 30 level. So you could always adjust your RSI depending on how you want to trade and the kind of instruments that you're trading. And as for the MACD, is basically an abbreviation that stands for moving average convergence divergence. So this shows you when there's convergence or divergence in a particular on a particular instrument. So when you see convergence is more of convergence is speaking to when two things are going in the same direction, while divergence is speaking to when two things are going in opposite directions. But in trading, when we see a divergence, we're expecting that when we see a divergence in the overbought region of the MACD, then we're expecting that stock might fall sometime soon. And then when we see a divergence in the oversold region of the MACD, then we're expecting that stock or instrument might do some upticks soon. So it's just there are so many. It's going to depend on the condition, or let me say the trading condition that you find yourself. But again, please try as much as possible to get familiar with a few of these indicators. You may not use all four of them at once, but one or two will definitely help you, in your competition. As for Bollinger Bands, it's very similar to the what's it called, to the relative strength index, in the sense that it is a momentum indicator. And in the market, what you basically want to do is follow that momentum. You don't want to be trading against the momentum. If majority of traders are buying a particular stock, you would naturally expect the price to go up. And that's the direction you want to be playing in. But if majority of traders are buying and then you are selling, then there's a problem. Your account is just going to get burned in no time. And yeah, that's basically it on indicators. The other part of technical analysis you would want to take very seriously would be chart patterns, because chart patterns are also very essential. Although in the context of Nigerian stock market, there are lots of inefficiencies, and that's why when you open up the chart, you are going to see lots of market gaps. You see lots of price gaps on the chart, so you would most likely want to do your analysis on the higher time frames, where you would see enough candlestick bars that help your analysis. But then again, it doesn't mean that you cannot trade with these chart patterns even on those smaller time frames in the Nigerian stock market. Sometimes the inefficiencies could even work in your favor, in the sense that when you see gaps, you could just change your chart from a candle chart to a line chart, and then you might be able to see these patterns a little more clearly. So we have the head and shoulders pattern, which is a reversal chart pattern. So it could either be a bearish or a bullish reversal chart pattern. But then again, you would most likely want to do more research on these chart patterns, just like you would do on key indicators, so that you can understand how they work and when exactly you need to use each and every one of them. As for the double bottom pattern, it's similar to the head and shoulders. But the issue with the double bottom, okay, it's not exactly an issue, but the thing about the double bottom pattern is that it is only a bullish reversal pattern. You would never find it being a bearish reversal pattern. So it performs only one function. You can only buy when you see the double bottom. The only time you sell is when you see a double top, which is not on this slide. And that's because there are so many chart patterns. There are numerous chart patterns. It just depends on the ones that you like, and the ones that, or let me say, the ones that you understand, and the ones that work according to your trading strategy. So it doesn't mean that using all of them is what will give you the best results in trading. Basically, what you want to do is pick one or two of them and use it very effectively. That's what's actually going to give you those wins, or let me say, make you the money that you're looking for in the market. So other chart patterns would include the ascending triangle and the cup and handle pattern. So please do some more digging on them, and then you would you should do very good in the competition if you understand at least one or two of those chart patterns. Now, talking of trading strategies, we've covered the fundamentals and the technical aspect of things. Looking at trading strategies now, it's broken into 4 major sections, and those 4 sections include momentum trading, value investing, swing trading, and mean reversion. So under momentum trading, what you want to do is you want to follow the momentum of the market. You want to buy stocks that are, trending to the upside, because the trend is usually going to be your friend. That's a saying in the market, that the trend is your friend until it ends. So if the trend has not ended yet, just keep following the trend, and you already stand a 70% chance of, winning your trades. And so if you follow the trend, it means you are following the momentum of the market, and it's also a good strategy. If you add maybe your RSI or MACD to your momentum trading strategy, then you just might come up with, some very good results in the market. But the issue with momentum trading is that you're always going to have drawdowns. Drawdowns are when your account goes into negative. It will now be a test of if or not you can manage your emotions to hold those drawdowns, come out of them, and then make profit off them. So it's would I say, high risk, high reward kind of trading. So depending on your strategy, you just know which to pick. So if you are risk averse, then you would most likely not want to, participate in momentum trading, because you might not be able to hold the drawdowns. And a part of momentum trading could also give you the permission to have tight stop losses, but most of the time, price might, hit your stop losses or reach your stop loss limits and then still move in your direction. That's actually very common. But your trading strategy is what will keep you in check most of the time when you take trades. Now, as for value investing, what you basically want to do is you want to only invest in stocks or companies that are valuable, like the name implies. So you would most likely be friends with your price to earnings ratio, your debt to equity ratio, as well as your free cash flow ratio. So you likely want to look at each of those metrics and see which companies actually gives you better metrics compared to other companies within the same industry that you're investing in. So one thing I would like to mention is when you're comparing companies, don't make the mistake of comparing a telecom company rather with a bank, because you will see a very wide gap in the metrics that you'll be comparing. So if you're comparing companies, make sure that you're comparing companies within the same industry. Now, as for swing trading is also one very good strategy. And this is majorly for those who do not have time to sit with the charts day in, day out. So if you want to practice swing trading, you likely want to hold your trade for weeks, perhaps 1, 2, or 3 weeks. And I'm aware that the trading competition is going to last for up to 6 months. So if you are going to be practicing swing trading, make sure that you're doing portfolio monitoring and rebalancing maybe every 14 days or every 10 trading days. That's every 2 weeks or every 3 weeks at most. So that when you see or when you observe that your portfolio is, going into a drawdown, you might want to monitor and then rebalance that portfolio so that, you get out of the drawdown as soon as possible. Because in as much as you're holding your trade for weeks, there are other participants competing in the same market as you are, and then they are entering the market day in, day out, taking scraps from the market, and then they are making quite a lot of money. As for the mean reversion strategy is basically you using your RSI and MACDs to spot overbought and oversold regions on the instrument that you're trading. So if an instrument is overbought, you know that it's likely going to drop soon, and then you want to sell that instrument. Or if an instrument is oversold, you expect that it's likely going to do some uptick soon, and then you want to buy that instrument. So your RSI on MACD is going to be your friend when you're using this mean reversion trading strategy. As for swing trading, one thing I'm going to add is to make sure that you use support and resistance levels very efficiently, because you cannot do swing trading without your key zones. Support and resistance level are those levels where so support levels are those levels where price gets to, and then it cannot go, or it's finding it difficult to go any lower. While your resistance level are the peaks of price where price has difficulty, trading higher. There are nuances to these concepts, I would always say, but I would like you to please use online resources to get better understanding of these concepts. I can assure you that if you understand the concepts and then you start to apply them, you make sure that you don't go outside your trading strategy. I can assure you that you'll come out in flying colors in this competition. Next slide, please. So as for risk management, like I said that this is likely going to be the most important takeaway from this session, because you cannot overemphasize on risk management. Risk management your risk management game has to be first class. You have to be on top of your risk management game. You cannot afford to have poor risk management. Okay, let me just put it this way. If you have poor risk management and you have a good trading strategy, you're not going to make money from the market, because managing your risk is what keeps you in the game. So you must protect your portfolio at all possible costs, right? So in risk management, you need to define your maximum risk per trade. So if you're investing in, let's say, Zenith Bank, for example, and you have a balance of 5 million, and you want to invest maybe 2 million in Zenith Bank, for example, you need to set a threshold that if Zenith Bank's price, if after investing in Zenith Bank, the price drops to a level where I'm losing 2% of the amount I have invested in it, then I'm no longer trading Zenith Bank. I'm going to cut that trade and wait for the price of the stock to reposition where I can probably re-enter again. And there's a lot of things that has to be put in place before this decision is taken. But the first thing that you primarily have to do before even taking the trade is deciding what maximum risk level you want to take on that particular trade. That's what's most important, and that's what will keep you in the game. If you just trade blindly without determining this risk per trade before executing the trade, then I can assure you that you won't even last up to a month in this competition before you would fall out. So another important thing that you will want to take into consideration is your minimum risk to reward. So this is how risk to reward works. If you are investing, say, 1 million naira in Zenny Bank's stock, right? And your risk is, let's say, 5%. You're expecting that if you lose 5% on Zenny Bank stock, if you lose 5% on the 1 million naira that you invested in Zenny Bank stock, then you're out the game. So for that 5% that you're risking on Zenny Bank stock, you need to have an estimate of at least twice as much of 5%. So what you're looking at is 10% in reward, where you're having 5% in risk. So for every 5% risk you take, you're expecting a 10% reward, which is 2 to 1 or 1 to 2 risk to reward ratio. So the 2 to 1 you are seeing on the screen is actually a risk to reward ratio that measures how much, or that compares how much you're risking with how much you're expecting to make from that trade. So if you buy Zenith Bank with 1 million naira, and then let's say your maximum risk on that trade is 5%, then it is expected that when Zenith Bank price goes up to give you a 10% profit, or let me put it in monetary terms now so you would understand me better. So you invest 1 million naira in Zenith Bank, and basically 5%, or 5% of 1 million naira should be around 50,000 naira, if I'm correct, right? So if you lose 50,000 naira on that, if you lose 50,000 naira on that trade, it means that you're out the market, right? So what you'll be estimating in that kind of situation is, if you are risking 50,000 naira, you'll be estimating to make 100,000 naira on that trade. So when your portfolio hits 1,100,000 or 1.1 million, that's when you made profit on that trade, and that's when you want to close that particular position. That's how risk to reward works. As for diversified positions, you always want to diversify your portfolio as much as possible, because investing all your money in one single stock puts you at the risk of a very large drawdown. You don't know what is going to happen tomorrow. You don't know what's going to happen in the next 2 weeks. You don't know what's going to happen in the next month. So what you want to do is you want to spread your equity across, give or take, 5 to 7 companies or 5 to 7 stocks at the same time. So you'll be able to see which stocks are overperforming, which ones are underperforming. So the ones that are underperforming, you could do something called portfolio reallocation or portfolio rebalancing by selling off the underperforming stocks and investing the rest of the money in the overperforming stocks. That gives you a balance. It gives your portfolio a balance, basically, and to really help you in managing your risk and your money properly. If you put all your money into just one stock, then I'm sorry to say that's not proper risk management, and you just might lose all that money in the blink of an eye. So you should also have a maximum drawdown target. I believe the maximum drawdown target in this competition is 10%. 10%, right? Yeah, 10%. So you cannot lose more than 10%. If you lose more than 10% of your equity, then your account is going to be automatically deactivated. So for you to be on a safer side, you could set a threshold for yourself of, let's say, 7 or 8%, so that you don't hit that 10% when you don't want to hit it. You'll most likely not know, because the market may be active at times when you're probably in class, or at times where you're probably doing some other thing. But the fact that you set a threshold for yourself already puts you in a safe spot, such that you set that limit that when this stock price reaches a particular amount, please stop my trade and, close out whatever loss I have at that point. That's how you set drawdown targets for yourself. You could set these drawdown targets in your trading strategy, or also set it on your trading terminal. It depends on you and the kind of trading that you basically want to practice. So some other parts of risk management that you likely want to take note of are position sizing, which I mentioned earlier. You should know how much to properly allocate to a particular stock. That's basically what position sizing is. You have 5 million, and then you decide that you want to invest 1 million in a particular stock. You have your reasons as to why. You don't just say, okay, I want to invest 1 million in Zenith Bank because I feel like the price is going to go up. You don't feel in the market. You don't feel in trading. If trading were based on feelings, then there will be so many trading millionaires right now. But you always have to take factual decisions when you are trading. You cannot trade based on belief or based on feelings. It doesn't happen that way. All right. So as for diversification, like I said, you want to diversify your portfolio, your equity rather, across around 4 or 5 to 7 stocks. It gives your portfolio a kind of balance, and it lets you avoid concentration in just one stock or one sector. As for correlation awareness, you also need to be aware of something called market correlation. So some stocks are correlated. Well, I experience this most of the time in commodities. I've not exactly experienced it in the Nigerian stock market, but you should also take note that in Nigerian stock market, some tech stocks can move together, or let me say some banking stocks can move together. Things like Zenith and UB could correlate positively in the sense that when Zenith is, buying over a period of time, UBA could also buy over a period of time. And you might want to ask what could cause that. Okay, let's say Access and UBA, for instance, now. If you look at a 1 month period for Access, you might see that the share price has been bullish over time. And if you look at a 1 month period for UBA as well, you might see that the share price has been bullish within that same 1 month. But they may not be bullish at the same pace. You might just see that positive correlation in terms of that direction. So you might want to ask that what could have caused that positive correlation between two different stocks in the same industry? So basically, UBA and Access are in the banking industry, and the CBN recently put out a circular in 2024 that all banks should recapitalize. So in the process of raising the capital for meeting those minimum capital requirements, you would most likely see investors putting, or let me say, you most likely see these banks doing things that we call rights issue or private placement. So in the course of doing that, they are getting influx of investors' funds, and that's just going to increase their share price. So UBA is not the only one that is trying to meet that capital requirement. Access is also trying to do it. Zenith is also trying to do it. Fidelity Bank is also trying to do it. All those other banks are also trying to do it so they can meet the regulators' minimum capital requirements. So in the course of doing that, they are getting influx of investor funds, and that is naturally creating demand for their shares or their stock. And then in economics, like they always say, the more demand you get for something, the higher the price goes. That's naturally what happens. So you might want to be aware of this kind of market occurrences so that you could properly take decisions. So if you're in a kind of market where the companies in that industry are trying to meet maybe minimum capital requirements, like I just gave an example of, then you would expect the stock or share price to move in the same direction over a period of time. It could be a month, it could be 2 months, it could be 3 months, or maybe even 6 months. But it's going to depend on your strategy. Like I said, next slide, please. So these are some of the tips that I said I was going to leave you with, and I believe this is second to the last slide of this session. So these are the common competition tips that I said I was going to give to you guys. That is, these are just going to help you scale through the competition and then come out in flying colors. So first is for you to start with a clear thesis for every trade. A clear thesis is more like a clear plan for your trade. So you need to plan your trade and trade the plan. You need to plan every trade before you enter the market. You don't just enter the market blindly. If you don't plan the trade, then there's nothing for you to trade, because you have to put a plan in place before you then execute that plan and then make money from the market. So if there's no plan, you cannot have a trade yet. If you decide to have a trade without a plan, then I can assure you that you're going to lose money. It's just what happens. So another tip would be for you to use both fundamental and your technical analysis for confirmation. I cannot overemphasize this. I cannot overemphasize this enough, because you need to combine both FA and TA for you to have a solid trading decision. If you are taking one and then leaving out the other, then your trading decision is most likely not an accurate one. Let me not say it's not an accurate one, because you can still make money from using either or both. But I mean, using both just gives you a better advantage, basically. So as for keeping a trading journal, you want to keep a trading journal to track your trading decisions. So as you take a trade today and let's say for instance, you lost some money. You want to know what went wrong. That's why you're keeping a trading journal. So in the market, there is never a losing trade. You only get lessons. You only get lessons in the market. So when you lose money, it means that there's something for you to learn. There's a reason why you lost that money. So your journal will help you in that regard. You also want to take note of setting stop losses before entering every trade. This is very important and is also a part of risk management. You want to also review your profit and loss, your P&L daily, and then adjust. This is what I called portfolio rebalancing and monitoring. So you want to make sure that you are monitoring your portfolio at intervals. When you're practicing swing trading, you could do this in maybe a 2-week interval, and then you could do this in a 2-week interval and then rebalance your portfolio based on what your P&L is saying. As for the last and final tip is going to be for you to start small and then scale winners gradually. This is a strategy on its own. You have 5 million naira in equity. It doesn't mean that immediately you should trade with all 5 million. You could have a strategy where you have 5 million naira in equity on trading day one, and then in week one, you've invested, say, 1 million naira in 2 sectors because you saw potential in them. Then the following week, you invest another 2 million naira in maybe another sector because you've seen potential that you initially did not see in that sector. So you would scale in gradually like that. It doesn't mean that because the competition starts today and then you've been given your equity today, it doesn't mean that you should, invest all the equity at once. You want to start small and then scale your winners gradually. And things to avoid have been highlighted on the slide already. Please do not trade based on tips or rumors alone. The market will always buy on the rumor and sell on the news. Please, I can overemphasize this. Don't trade on just tips or rumors. Make sure that there are facts backing your trading decisions. Avoid over trading as well. In trading, less is often more. The less, it doesn't mean that the more number of trades that you take, the more money you make. That's not how it happens in trading. Most of the time, or let me say from my personal experience, the less number of trades you take, the more money you make. And you just experience that over time. As for revenge trading, I will advise you not to revenge trade after a loss. Like I said, there are no losses in the market. There are only lessons. As for your risk, please do not risk more than 5% on one single trade. This is even way too much. You should not risk more than 1 to 2%, considering the conditions around this competition. You should not risk more than 1 to 2% on a particular trade. Now, as for your losers, don't hold drawdowns and be hoping that they are going to bounce back into profits. Once it has reached your drawdown limit, just cut the trade or close the trade and then do a kind of portfolio rebalancing, invest the rest of the money in the part of your portfolio where stocks are, performing very well. Fear of missing out is a very common thing as well in trading. You might be scared that you miss out on this, stock price at this point in time. And maybe other traders are saying they've already bought that stock or they bought that instrument. I can assure you that your own opportunity will come. The market's always full of opportunities. You're always going to get your chance to, take your own trade. Now, finally, I want to leave you with these 3 pillars. First would be that you please analyze before you act. Use both fundamental and technical analysis. Also, please manage your risk first. Profits are always going to be secondary in the market. Your risk is what is, most primary. And finally, please ensure that you stay disciplined and always know that emotion is your biggest enemy in the market. I wish every one of you good luck in the competition, and please always trust the process. I will entertain questions now. If you have any questions, please ask.
Thank you so much, Olayemi, for the insightful discussion. All right, everyone on the call, thank you so much. Everyone on the call, he has asked for questions. So if you have any questions or you need clarity on certain discussed topics, okay. So we have one hand up. So please raise your hand if you want to ask your question directly. And if you don't want to, you can just drop your question in the chat box. Daniel Ben, please go ahead with your question.
Okay, thank you for the lecture. I want to ask, is there any platform that we can use to check a company's news?
Thank you very much for that question, Daniel. So talking of platforms where you can use to, check news and all of that. As for Nigerian companies, basically, if you want to get news about them, a common platform that traders usually use is Nairametrics. You always get corporate earnings news and corporate earnings reports from them. But there's also a place on the NGX website where you get corporate disclosures. So you could also use the NGX website to your advantage. Any new thing that is happening around the company will be disclosed on the NGX as long as the company is listed on the NGX. So I hope I was able to answer your question.
Yes, thank you. Thank you very much.
Thank you so much. Okay, the next hand that is up is Rocky. Rocky, please go ahead with your question. Hi, Rocky. Okay.
Okay, sorry. Good afternoon, ma. And good afternoon, sir. So, the question I would like to ask is actually about the email that we received. So, the question I'd like to ask is that based on the email that we received, there was a message that was dropped about the sponsorship video, and the sponsorship video is actually for us to get more sponsorship so that we can actually increase our equity, as that will actually be an advantage for us during the competition. So, I want to ask that what is the like? Is there any minimum capital that we must actually have for that sponsorship?
Okay, thank you very much, Rocky, for that question. So, concerning your question, there is no minimum capital requirements per se, but the maximum capital will be communicated in due time. I hope I answered your question.
I didn't hear what you said. Yes, sir. Is what?
So I said concerning the capital requirements or minimum capital requirements, I said there are no minimum capital requirements per se, but the maximum requirements will be communicated in due time. Did you get that?
Thank you, Olayemi, for your response. The next hand that is up is from Ezekiel. Ezekiel, please unmute your mic and ask your question.
Yeah, good afternoon, everyone. So thank you so much for the, should I call it tutorial? It was really helpful since we are new to this. So my question is, yeah, so just like same question that Rukib actually asked. He said, concerning the support, is it financial support? Are we asking people to support us financially towards the competition?
Okay. Thank you very much for the question. So let me just say that the context of that support, like read from the email, was cutting around things that, or let me say things, people like your alumni. So if you're looking at support, you most likely want to reach out to maybe your university alumni, perhaps your, did I say department ESCOs, your faculty ESCOs, who could, probably provide that support to you. But like I said earlier, there is no minimum amount per se, or the maximum will be communicated to you, in due time.
Thank you, Olayemi. Can everyone hear me? Good afternoon, everyone. Can everyone hear me?
Yes, ma'am, we can hear you.
Okay, so let me add to what Olayemi has said. We here, if we have any of your team as our alma mater, we can also support you when the competition gets intense. So it's not just you sorting for sponsorship, we can also support you. So if I'm from University of Ibadan and I feel, I need to support my alma mater, I can go ahead and mobilize people that are from UI to join you and help you win the competition. So it's not just you sorting for, we can also help you win.
Thank you very much, ma'am. Yeah, so thank you very much, ma'am, for adding to the comments. So I have a question in the chat box. And the question reads, concerning risk management, do you manually set stop losses yourself, or there's an inbuilt system that you can utilize to help you with stop losses? So basically in stock trading, there are no inbuilt systems in stock trading to help you close out your trades when you set stop losses. What you will do for yourself is such that you are buying you're buying units of shares from a company. So you as a trader or with your trading strategy already know how much of that amount, or let me say how much of the money you are spending that you want to forfeit. You already know. So when it gets to that limit, then it is you are let me say you are obligated to close out on the trade. So there is no inbuilt system that is going to just close out on you, that's just going to close your trade when price gets to a particular limit. You only see that with sports trading. Sports trading is different from stock trading. All right. So in sports trading, you could set a stop loss that helps you to automatically, whether or not you're online, it could, close your trade when price gets to a particular limit. But in stocks, you are not doing sports trading in stock. There are two different things. In stock, you already have a predetermined risk limit where you as a trader have decided on before you buy units of shares in the company. So when it gets to that limit, you can then close out on the trade.
Let me add up to what Olayemi has said in practical terms. Let's assume you are a trader. Yes, you are a trader because you soon become a trader. You are a trader in stocks, maybe you sell Pepsi or something. You bought your stock at a particular price, logistics and everything, but brought your cost price to a particular amount. And you know that I won't go beyond this price to sell this stock. You won't go lower. So you have a stop loss. Oh, maybe I can also sell it as my break-even point because it's staying longer in my stock. So it's stop loss. Stop loss is emotional decision. You are deciding whether, I want to sell it at 10 naira and 10 naira. Even if it's going to go beyond 10 naira. I want to stay at 10 naira and make this profit. So stop loss is like your own decision. It's a discipline on its own. You just have to look for a way to build your self-discipline, your emotional discipline about stop loss position. Just once you have your trading, you've traded the stock, you have your weighted average cost, you know at what point you want to make, maybe 5% up or 5% down. You won't go beyond that. You set your stop loss between your team or within yourself. I hope I explained it a little bit better.
Thank you very much, Ma.
Thank you, Adejoke. Thank you, Olayemi. Olayemi, there's a further comment in the chat box.
I see that now. So it reads that if it's reaching the limits, do you sell all your shares or some? So that's dependent on your trading strategy. Like I said, you're always going to have to do portfolio rebalancing, right? So if you see that you are in a losing position and you hold maybe 1,000 units of shares from that particular company, then you could decide to sell maybe 500 out of your 1,000. Perhaps you are thinking that you might get out of the drawdown soon, or that company you still believe that something would, turn around that share price and take you back into profit. So it's heavily dependent on your trading strategy. You could sell, or you either decide to sell all, or you sell a fraction, or you sell a majority of your holding in that particular company. I hope I was able to answer your question.
Thank you so much, Olayemi, for your feedback and your answer to their questions. There was someone from yesterday's session. Okay, thank you so much, Damilola. There was someone from yesterday's session. I believe his name is Alex. Alex, you had a question yesterday that I told you to push it to today. Do you still have the question? Do you still want to ask the question? Okay, Adeshola. Okay, maybe. Please go ahead.
Yes, good afternoon, everyone. I was the one that asked question yesterday.
All right.
I
Thank you so much,
was
Adeshola. Please go ahead.
asking about the current market on the Nigerian Stock Exchange when I saw something about inflation and interest rates. Like I want to ask that what are the factors, fundamental factors that is currently affecting the stock market, and I don't know if I can actually know the current trend of the Nigerian Stock Exchange market. That was my question yesterday.
Okay. Thank you very much, Alex, for the question. So your question splits in two parts. So one part cuts across the relationship between interest rates and interest rate and something. I didn't get it, but the second part of your question cuts into the current trend of the Nigerian stock exchange market. So at the moment, looking at what we've had from last year coming into this year, or let me say from 2023 to date, the NGX ASI, that's the all share index, has been on an upward trajectory. So it's been bullish ever since. It's had a little dips, but majority of the bullishness has come from reforms by the current administration. And one major reform, or let me say highlights of this reform would be the CBN, the new CBN recapitalization for banks, minimum capital requirements for banks, and also the NICOM minimum capital requirements that was increased for insurance companies. So all of those reforms, like I explained earlier, that reforms usually prep activity in the market. And those reforms that were rolled out 2023, coming into 2026, were reforms that made investors fund, drive activity in the Nigerian stock exchange market. So when you start seeing investors putting their money in the market, buying more of these company stocks and company shares, then you would likely always see the stock prices of those companies in that industry, push towards the upside. And the way the Nigerian stock exchange works is such that the financial institutions are usually the driver of the NGX ASI because they hold majority of the market cap. So once it's just like the relationship between Bitcoin and altcoins. I don't know if you are familiar with other commodities, but there's a relationship between Bitcoin and altcoins where if the Bitcoin is down, all altcoins would, also go down, and the Bitcoin is up, all altcoins usually go up. So that's the relationship between the banking industry and the NGX ASI. Once banking stocks are doing well or are performing, then you will naturally see the all share index also, do some good numbers. That's the current state, or let me say status of the NGX ASI, or let me say the market, the Nigerian Stock Exchange at the moment. And as for the second part of the question that cuts into the relationship between, I don't know if you were trying to say the relationship between interest rates and the stock markets, or the relationship between interest rates and something else. Could you please clarify on that before I answer the second part of your question so I don't miss it?
Okay. No, I was trying to ask that the relationship, that how does inflation and interest rates affect the trend of the market? That
Oh,
is what I
okay,
was
okay. Okay, I
trying
get
to know.
it. I get it now. I get it now. So looking at the relationship between inflation and interest rates, before we then look at how it affects the Nigerian stock market, I want you to first know that inflation is something that is in every economy. The only thing different is the levels of inflation in specific economies. So if you look at Nigeria, where inflation is reading 15.06%, that's based on the most recent reports for February. And the higher inflation goes, the more the central bank would have to increase interest rates to curb that inflation. And the lower it goes, the more they'll have to cut rates to stimulate the economy. So if inflation, as inflation has been on a downward trajectory in the last 2 years, yes, and that trajectory gave the CBN the confidence that it's going to continue. So they have had to cut rates from 27% to 26.05%. They cut by 50 basis points in their last meeting in February. So that's basically the relationship between interest rates and inflation. Let's now relate it to the relationship between those two and the Nigerian stock exchange markets. When you start seeing interest rates, increasing, or when you start seeing the CBN increase interest rates, they are trying to attract people to investing more money and spending less money. So people will most likely go and put their money in the bank, save it, earn interest over a period of time. They will not spend those money on, opening shops, doing businesses, buying things, because they get more value investing that money than spending it on other things. So what the CBN will now try to do is, they know that the more they increase these interest rates, the more people are going to keep money in the bank, and then it will naturally slow down the economy, to an extent. So how that affects the stock exchange market is, once people start to save money in the banks, you will most likely not see money go around, and you will most likely not see them put money in the stock market. So what they would likely do is, they will just want to start storing all of those money in the bank, and then you will not see activity in the stock exchange market. But when the CBN starts to cut interest rate, that's when they start to reduce these rates. Then they are chasing people away from saving money in the bank. They are encouraging people to spend more money. And then you are going to be seeing banks compensate people less for fixed deposits and investments that they make. So if people see that the interest rates on their investments and bank deposits are not attractive enough, they will most likely look for an alternative. And that alternative is the Nigerian stock markets. They're going to put their money in stocks, because they know that if they keep it in the bank, they'll be getting less value for the money. So what they will most likely do is they'll put more money into stocks, put more money into the banking industry or whatever company that they want, so that they can get higher potential return. So if you now look at the current landscape that we are in at the moment, in CBN cut rates in February, and then we've seen that translates into heavy trading activity in the Nigerian stock exchange market. If you compare the ASI, that's All Share Index, from February to date, you're most likely going to see an upward trajectory, and that was as a result of the interest rate cuts that was done by the CBN in February by 50 basis points. So I hope I was able to answer your question. If you have any more, we could please ask. Thank you.
Thank you so much, Olayemi. Does anyone have further questions for the facilitator? Hello, please, if you want to speak, kindly raise your hand and you'll be called upon. If you have further questions, kindly raise your hand so I call you up, so we have an organized session. While we wait for people to ask their questions, this is a reminder to fill in your documentation. A document was requested from all the participants. Please fill it in and send it back. The deadline for the submission is on Friday. Please fill in your documentation and send it back as soon as you can before the deadline. Thank you so much, everyone. So I don't see any other hand up for a question. Neither do I see any comment in the chat box with a question. Okay, Damlola, I see you are trying to make a comment concerning documentation. Okay, Damlola, I'm not seeing the complete comment. Okay, Adeshola, please go ahead.
Okay, about the documentation and the school HOD signature, Are we supposed to submit that to on Friday?
Okay, thank you so much for your question, Adeshola. Dotsun Shegun on the call,
Yeah.
please, can you answer the question?
So regarding that, if you're on the WhatsApp group recruited for you guys, you will notice that we've been sending a message requiring you guys to respond to the congratulatory mail we sent earlier. So we'll actually advise as soon as possible. If possible, you can send it today. That will actually be appreciated because the longer it takes is not good enough. So as soon as your team lead can send it to us, please, we encourage you to send it as soon as possible.
Okay, thank you very much. Thank you very much. We'll work on that.
Right, thank you so much, Dotsun, for your response. Thank you for your question, Adeshola. Dotsun, there's a question in the chat box. It says, what does the data collection for each member entail?
All right, so if you check the documents we sent to you, so on the congratulatory mail, we attached 3 documents. So for the letter that was addressed to the 3 team members, you are required to sign them, acknowledging you receive the mail and send back to us. And also we require you provide us a valid means of ID, preferably a student ID and any other means of ID, let's say your A9, yeah. And also the letter of recommendation from your HOD. So in the mail also, I think there is a draft there. So your HOD should sign and also send back to us. Thank you.
Thank you, Dotsun. Okay, we have 2 minutes to the end of this session. Does anyone have any further question or clarification regarding the documentation or this presentation? Adeshola, please go ahead.
My last question is on this last this thing we had about the risk reward ratio, the risk reward that we are going to be using. I saw something like 2:1. So does that mean that we are risking minimum of 2:1 and we can risk above 2:1? I don't know if you get what I'm asking. When we are taking trade, can we risk more than 2:1, or yeah, one is minimum on each? Hello?
Hi, Adeshola. I got your question. Olayemi.
Thank you very much for the question, Adeshola. So to answer your question, the risk reward ratio is basically a ratio that shows how much you are risking in the market in relation to how much you'll be getting in return. So 2:1 means that for every 1 naira you are risking, you're getting 2 naira in return. So that basically translates to how much you are risking multiplied by 2. So if you are risking 50K or 50,000 naira at that point in time, you'll be getting 100,000 naira in profits. That's what you're projected to get. So when your profit reaches 100,000 naira, you close out on your trade. That's what the risk to reward ratio explains. So you could have higher than 2:1. So the 2 is the amount you are expected to get in return, while the 1 is the amount you are risking. So you could have 3:1, you could have 4:1 risk to reward ratio. So if you have 3:1, it just translates to for every 1 naira you are risking, you're getting 3 naira in return. If it's if it's 5:1, or that's 5:1, it means for every 1 naira you're risking, you're getting 5 naira in return. So that's basically whatever you're risking multiplied by 5. That's what it translates to. So it's just a ratio. It's not in monetary terms. So if if you've done your analysis and your strategy and everything, and you decide that, oh, after analyzing and everything, this is how much I can afford to risk on this particular trade. Let's say give or take it is 70,000 naira, right? That's your risk on that one trade. And your risk reward ratio, I would assume, let me just say, for instance, it's 5:1. It means that you're expecting to get that 70,000 naira that you're risking in 5 places. That's 70,000 naira times 5, which is 350,000 naira. So when your profit hits your equity plus 350,000 naira, then that's when you close out in your trade and you've achieved your risk to reward ratio. I hope I was able to answer your question.
Thank you so
Yes,
much.
yes.
Thank you for your question.
Maybe
There was okay. There was another hand up. I think that was Damnola's hand, but is now down. Okay, so I believe we have no further questions. If you have questions, please pen them down for tomorrow's session. Tomorrow's session will hold same time by 3 p.m. to 4:30. So you can have your questions ready, your clarifications ready. Please be informed. Do not forget to fill in your documentation as the deadline is this Friday. Thank you so much, everyone. Thank you so much for joining. Thank you for taking out time to listen. This recording will also be made available to you, and the document as well. The PDF will be made available to you and the recording. Thank you, everyone, for your participation. Thank you for joining. I hope you have a pleasant rest of your evening. My name is Adenike Balogun. Thank you. Enjoy the rest of your evening.